Welcome to Tech Talk and Transformation Insights, the podcast brought to you by Cogent Integrated Business Solutions, your trusted partner in the world of IT solutions and business strategies. Tune in to Tech Talk and Transformation Insights and stay one step ahead in the fast-paced IT and digital marketing world. Hello everyone. Welcome to this new episode, where we are going to talk about venture-backed startups and why they often choose alternatives to bankruptcy. My name is Connie, and I'm your host today. I'm here today with Maliha, a university student with a background in e-commerce and digital retail, and we are here to bring you this episode on behalf of Cogent Integrated Business Solutions. Together, we're going to explain the basics of these areas and the relationship between them. To begin our podcast, for those listeners who are not very acquainted in this field, a venture-backed startup refers to a company that's in the initial stages of a business and supported by venture capital. Isn't that right?
That's right. We are talking about the first stages of operations in a business. So, all startups and business endeavors, they require a source of funding. And that source of funding can really vary depending from business to business based on individual factors. So, to sort of familiarize our audiences with the concept of VC-based startups, here are some examples of successful VC-based startups, such as Airbnb, Peloton, DoorDash, WeWork, Instagram, and Snapchat. These are all very well-known names that have been supported by venture capital funding.
Right, that's great. So, could you tell us some more about venture capital and what it means for startups or small businesses?
Of course. So venture capital is a form of private equity funding. So a venture-backed company is a business that is at least partially funded by a venture capital firm, also known as a VC firm. So VC-backed companies are often startups that will raise money in exchange for equity from the VCs and other private market investors. And these companies, they tend to be in the growth stage where they still are in need of financing. And so, VC companies, they'll see the potential in the business. They'll be willing to invest with the expectation that the business is going to grow, and they're going to see financial rewards for themselves. So venture-backed startups, they try to go public or sell to another company through an acquisition deal and achieve financial return for all equity holders, as I previously mentioned.
And what are the benefits and constraints of venture-backed startups, and why are they a preferable form of funding for startups?
So, the benefits of VC firms are the financial support that they receive from the investors. The funding allows them to expand rapidly and achieve greater success. And additionally, VC-backed startups, they have access to experienced investors who can provide, valuable industry advice and guidance. And these two factors, the financial support and the access to mentors who know the industry and who can guide the business activity, often offer startups like accelerated growth and offer higher success rates, which leads to heightened visibility and reliability in the business world.
Right, so you would say it's a better option.
Oh, yeah, definitely. But however, one of the primary challenges of VC-backed startups is the potential loss of control that may result from VC investment. So, for example, a venture-backed firm typically would seek a significant stake in the company, and they could demand a considerable degree of control over the startup's operations and decision makings. And additionally, VC-backed startups are pressurized to produce results immediately and effectively, aka deliver returns on investment. And so, as I said earlier, sort of briefly touched upon it, it has been traditionally considered to be a very lucrative and consistently reliable route for like startups, right? It gives VC backed firms extra sources of funding and mentorship from business experts. However, that has recently begun to change since almost 75% of VC backed startups are failing in recent years.
Wow, that's a pretty big amount of startup failure rates, especially for a venture that was traditionally thought to be a fail-safe option. However, why are these failures increasingly becoming a trend?
Well, startup failure can occur for various reasons, such as financial mismanagement, human resources challenges, product shortcomings, strong competition, a lack of market need, and more. However, we believe that the trend of increasing VC-backed startup failure is due to a combination of forces, such as the Silicon Valley bank's collapse, mass layoffs, and recent economic instability. Additionally, due to tax hikes by the Federal Reserve, they're paying higher interest rates on loans, making borrowing from financial institutions or accepting forms of debt-based financing increasingly unviable, especially considering that today's competitive market and various other limiting factors.
So, could you tell us a little bit about what defines success and failure in the VC-backed startup ecosystem?
Oh, definitely. Before that, I'd just like to mention that all of the information we're talking about is primarily for a US or North American market. So, a lot of the process and financial systems in place and economic reasons may differ from region to region, just as a disclaimer. So,
Right, yes.
success with startups, yes, is very important. Anyway, success with startups is often framed as reaching a liquidity event or an exit that provides financial returns and rewards to the investors, founders, or employees. These are also known as like the main stakeholders who are involved in business activity. And there are two main ways to achieve this successful exit, so to speak. One, you can either sell the company, or two, go public. Each option is considered a successful exit. When startups fail to achieve this, it's considered a failure. So, after understanding the current business climate, not only for startups but for established organizations as well, it's important that we understand how startups should fail successfully in the event that they go under, and understand the importance of having a well-developed system to support startup failure.
Perfect. So, tell us, why don't most startups file for a formal bankruptcy, which is what most of us think of when we consider business failure?
That's a really good question. So, bankruptcy formally is a legal proceeding initiated by an individual or business when it is unable to continue operations in a profitable manner and repay outstanding debts and obligations. However, formal bankruptcy isn't often the most viable option for business closure due to the implied consequences of startup failure should they file for bankruptcy. Luckily, there are alternative proceedings available to reabsorb the startup, ensure the liquidation of assets, maintain the company's reputation, and overall ensure that startups fail as successfully as possible. In this episode, we aim to consider the alternatives to bankruptcy and how the socioeconomic status of the startup ecosystem influences the role. As a side note, we should note that these initiatives or proceedings are not necessarily universal and are mostly US centric.
Right. What we were talking about earlier. So, are these alternative proceedings more beneficial or not?
Yeah, indeed. So the consequences of startup failure are important because one, the inability to withdraw from involvement can reduce incentives to invest in the startup, right? It's a very high risk. If it does fail, you can't, get your money back as an investor. Two, the speed, effectiveness, and consequences of the startup failure can pose risks for founders of new startups, which can potentially generate uncertainty and stagnate startup growth and startup culture. It can also affect the labor politics and economics of employees within the technology sector specifically. And three, these dynamics affect the flow of talent and the ability of entrepreneurs to remain in possession of their intellectual property. So, to conclude, these alternative proceedings are more beneficial because the ability to fail with honor is critical for all involved stakeholders and is vital for the startup ecosystem.
But apart from failing, why do startups avoid or don't like to declare bankruptcy? Is it less convenient, not wanting to face reality, maybe, like in a denial thing, or just to avoid legal paperwork?
So, VC backed startups are unlikely to file for traditional bankruptcy due to a few reasons. So, first, the typical capital structure of backed startups is unlikely to fall for traditional bankruptcy because the most significant asset of most startups is intellectual property, such as patents, for example. And these are more difficult to realize the value from, and hence, most banks do not lend to startups because of their high risk.
Right.
So, hence, VC capital fulfills the need to finance high risk technology startups. VCs act as general partners of funds that invest in a portfolio of startups. They benefit from receiving an annual management fee and a percentage of the profits. They also seek convertible preferred stock with protective characteristics such as voting of rights. Hence, VC investors, they aim to protect themselves by allocating separate cash flow and control rights without incurring the costs of bankruptcy. So if we were to file for bankruptcy, it would negatively impact the investors who are supporting the startup. The second reason is that formal bankruptcy isn't a fit for most startups for reasons beyond capital, or like capital portfolio or capital structure. The assets or value in the startup, they're often intangible. Like I mentioned earlier, they're mostly intellectual property, such as, human talent or, the likes like patents, etc., which can disappear if a startup is known to be in distress. It can be revoked. And three, the typical startup is embedded in like a network of reputational concerns and limitations within the VC ecosystem. So you have to save face, essentially. Reputation concerns, they can constrain opportunities, meaning that the symbiotic relationship between VCs and startups would be endangered. So VCs, they try to protect their own reputation over continuing investment in a failing firm. So a bankruptcy lawyer was once quoted saying that it was quote unquote taboo in the Silicon Valley to use the term Chapter 11 simply because of how much it would stagnate companies' growth and limit their business opportunities. Even if they're already failing, no one is going to want to associate with them or, have like a merger and acquisition, like there is really no way of going forward in that scenario. And for the fourth and final reason, VCs tend to invest in startup portfolios with the intention of only a select few providing high returns on investments. They know that not every business they invest in is going to, be financially successful or popular with consumers. So this principle is known as the, quote, power law, unquote, of VC. If a startup is perceived as being unable to provide these returns, incentives, to ease investments into said startups. And VCs don't want to be involved in a prolonged bankruptcy process due to the opportunity costs and potential reputational harm.
Right. Thank you for that very complete answer. And what strategies would you say that are available for failing startups?
Ooh, okay. So I'd say there is four main ones: merger and acquisition sales, acqui-hire transactions, assignment for the benefit of creditors, and wind, wind downs, turnarounds, and additional alternatives. So I've listed them in order of preferability. Essentially, like what would be the best options that, failing startups are trying to vie for. The first is merger and acquisition sales. So selling the company through a M&A deal is the most preferable for startups, which cannot continue independently. However, this can be risky because, especially in established startups, M&As, they allow for like a graceful exit for the business and the talent due to, the positive reception and perception by the market. And this can't be easily classified as a failure or success because of how strategic it is and how there is a potential for gain and growth upon acquisition. It also validates, the value of the product itself. If you're able to sell your business to, another big conglomerate or corporation for, let's say, $100 million, you can objectively say that, oh, the product or brand that I've created is worth $100 million. So hence, is it really a failure?
Right.
So it blurs those lines. And like I said, reputability is very important in this business where investing and presenting a certain image to consumers matters. So there are two forms of mergers and acquisition. First is the purchase of equity, and the second is asset purchase. Purchase of equity can be done quickly. They can minimize employee and customer loss. The management process is also very private. Asset purchases are slower to complete. They allow for selectivity in the transfer of assets and liabilities. So, for example, an example of an asset purchase would be Quibi, which was a streaming service startup that required almost $1 billion in funding. However, it was unable to get enough paying subscribers to maintain its business operations and remain profitable. Hence, Quibi transferred its remaining cash to investors and was acquired by Roku, which is an organization that specializes in smart TVs and streaming services in North America. So we could see how instead of purchasing equity, they sort of wanted to transfer their assets, their intellectual
Mm.
assets, and physical assets to another company to sort of, get some sort of return on investment, right? To get some sort of money that they can distribute to the stakeholders, to the employees, etc.,
Yes.
etc.
Mm-hmm.
That's very important. Two is acqui-hire transactions. So acqui-hire transactions are similar to M&As. However, its primary purpose is to hire the talent as a form of asset sale. So it's particularly valuable for innovative products or intellectual property. For example, having an experienced team who are familiar with each other and the product can really make or break the company, especially if they're being acquired by another company. Maintaining, the workplace balance, like that dynamic, and sort of having a deep understanding of like a pre-existing system that has been proven to work saves a lot of valuable time and money investing from like the human resources side, for example. So for founders, can be a successful exit since the positive reputation can provide a form of monetary value in the future if the founder is a serial entrepreneur. And there's no set structure in acqui-hires. On a small scale, it can be a cash transfer. On a larger scale, it can involve stock purchase, merger, and intellectual property.
Mm.
So the third type of strategy recommended for venture-based startups that are trying to avoid filing for bankruptcy or they're trying to, fail successfully is called assignment for the benefit of creditors, also known as ABCs. So ABCs is a state law insolvency, and debtors' assets are assigned to an assignee who acts as a trustee over the assets beholden to them. ABCs can be cheaper, they can entail less work for corporations, and have less oversight than is normally required for formal bankruptcy proceedings. However, a potential downside of ABCs is that assets are generally sold lack without like a bankruptcy protection for buyers, unlike in a bankruptcy case, which does offer legal support for buyers and like a guarantee of sorts. However, recently a development has arisen to reduce the risk associated with ABCs, known as the ABC 2.0 insurance. And this allows for private players to provide buyers with bankruptcy protection alternatives. So these are professionals known in the business of serving ABCs. So one really big, well-known, like name brand sort of organization is called Sherwood Partners.
Mm.
So they are an industry leader in particular, and they cover aspects of startup turnover and acquisitions such as receiverships, ABCs, and bankruptcies. And the existence of having specialized players in the startup ecosystem is really important because it demonstrates the need for efficient ways to get rid of failing startups while continuing to have a healthy ecosystem. Especially
Yes.
with
Right.
the way the economy is, the way the startup ecosystem is looking currently, it's important to have sort of like a way of almost recycling these failing startups.
Mm.
And
Right.
so finally, we are down to wind downs, turnarounds, and additional alternatives. And these are sort of your last resort, I won't lie.
Mm.
They're for startups which have low perceived value. In these, the business can either sell off the assets directly, shut down the business, or carry out a voluntary dissolution, whereas like they take apart the business activity. And the dissolution can provide directors with protection from personal liability if it's done well. And additionally, they can enact recapitalizations and distressed turnarounds or go public for a special purpose acquisition company known as a SPAC. So, for example, of this less preferable alternative solution, we have WeWork, which was very popular at like the height of its fame. It was an American company that aimed to provide co-working, office, and digital spaces to the American corporate world, and it had a failed attempt at an IPO, like initial public offering, which required a bailout from private investors. The failure was exacerbated by the COVID-19 pandemic, which led to mass buyers canceling their co-working space purchases as work shifted to a remote
Mm.
environment. And
Right.
maintenance costs were high, and the business was fueled by like a very millennial work culture almost,
Mm-hmm.
which died as the economy shifted and as digital working became somewhat more socially acceptable. So WeWork was making losses like for a couple years, I believe, and they officially declared Chapter 11 bankruptcy following a period of not finding buyers who were willing to absorb the business. This is one example of the difficulties of failing successfully because it's so hard to find buyers or opportunities for failing businesses that are in line with the business itself and with the current market.
Right. Well, Malika, thank you so much. I think that's it